When investing, especially if you're using an index fund or ETF provider just like Vanguard, then it's very common to be invested in a global portfolio. A global portfolio invests in various stocks from all around the world, targeting various market sectors and particular countries, in an attempt to track the global markets. They're popular because they're diversified. They give you everything that you're ever going to need in one portfolio. But the thing is about global portfolios is that there's more than one way of making them. By building different portfolios that have a different combination of funds, you can make portfolios that are more complex, but generally have a lower ongoing cost. Complex portfolios can be a bit more difficult to manage, but perhaps it's worth it for that reduction in cost that you tend to get. So, with that in mind, we're going to go through 4 global portfolios that you can build using the range of index funds that are available on Vanguard's platform. Each portfolio is going to increase in complexity throughout the video, so make sure to stick around to see for any portfolios that match your investing style. Big shout out to my mate Ed Crosby, who's a fellow admin over at the Vanguard Investors UK Facebook group. He's the one who actually conceptualised these portfolios and put them in the group. If you are a Vanguard investor, then I do recommend that you join the Facebook group. It's a really active community, and if you have any questions, then the group are generally really good at answering them. Finally, we just wanted to remind you that we are not professional financial advisors. If you want independent advice tailored to your own circumstances, then you should seek that from a professional. Basically, we've just shown you these portfolios for a bit of fun, and to also show you the process behind building a global portfolio. With that out of the way, let's get into it. So, to start today's quest to look for the best global portfolio that we can invest in on Vanguard's UK platform, we first have to define exactly what we're looking for. There are a few key criteria that need to be met to make sure that the portfolios are legit. First of all, they must include a lot of stocks. Thousands of stocks. If we want our portfolios to represent the global markets, then we're going to need a lot of stocks to do that. Investing in one stock from every country is not going to be representative of the global markets. Secondly, we need to make sure that we are invested in different market types from all around the world. By this, I am basically referring to the developed and emerging markets. Developed markets include countries that are considered to be developed in terms of their financial or economic markets, whilst emerging markets share some of the same traits as developed markets, but they're just not quite at the same level yet. Examples of the developed markets include the US, UK, and Japan, while some examples of the emerging markets include India, China, and Taiwan. So, if we can build some portfolios that invest in thousands of stocks from both the developed and emerging markets, we'll have a fairly comprehensive global portfolio. To help us figure out how much we're going to invest into each of our funds to build up our global portfolios, we're going to be looking at some FTSE Russell indices. FTSE Russell are an index provider. This means that they build collections of stocks in order to represent certain types of market. The indices that they make are used by many Vanguard funds as a sort of baseline to track. So we're going to do that too, and use our indices to help us build our portfolios just to make sure that we're on the right track. It basically means that all of our portfolios are going to have the same core ingredients, or at least they're going to invest in the same countries with similar allocations. The thing that's going to be different is the funds that we actually invest in. Because we're going to be investing in different funds, the fees are also going to vary. It's also worth mentioning that we're not just going to be looking at the ongoing charges. The other type of fee that affect Vanguard index funds are known as transaction costs. This actually has nothing to do with us buying or selling stocks. It's actually related to Vanguard behind the scenes buying and selling the stocks that are made up to manage a fund. Vanguard have to pay dealing costs and taxes when they do this. They're typically quite low, but they are still significant. The transaction costs, just like the ongoing charges, are automatically taken away from the returns that you receive when investing in a fund. So it's not something that you actually see directly. Either way, it's still worth considering. With all that finally out of the way, let's get straight into portfolio number 1. As I mentioned before, we're going to start off nice and easy, and we'll gradually increase the complexity as we make our way through the video. So to start us off, our first global portfolio is just going to be made up of one fund. The good old trusty FTSE Global All Cap Index Fund. Now of course, this is the most obvious starting point. An all-in-one global tracker that constitutes a global portfolio. The fund tracks the FTSE Global All Cap Index, which is the same index that we'll use later in the video with some of our other portfolios. We have got an entire video dedicated to this fund, but in summary, it invests in around 7,000 stocks from large, medium and small size companies from all around the world for a very reasonable ongoing charge of 0.23%. You can't underestimate getting this much diversification in just one fund. It's perfect. You could literally just invest in this fund for the rest of your life and you'd have a fairly solid global portfolio for a relatively low cost. The portfolio data gives us an insight into how a typical global tracker looks, with the US dominating the fund with around 60% allocated to it, with the other countries having a few percent each. It also provides a broad range of market sector diversification, with technology leading the way as it stands. As mentioned, the fund stands out because of the sheer amount of diversification that you get. balanced with the simplicity of it just being in one fund. 7,000 stocks is massive, and the fact that it also includes small-sized companies adds another layer of diversification that some other funds miss out on. There are other all-in-one global funds on the platform, such as the FTSE All World ETF, VWRL, or the Life Strategy 100 fund. However, in our opinion, the FTSE Global All Cap Index Fund just about beats these, as it's more diversified and makes a more complete global portfolio. The portfolio has an ongoing charge of 0.23%, with a transaction cost of 0.09%, which adds up to a total cost of 0.32%. The total number of holdings is around 7,000. So if you're looking for an all-in-one solution for a global portfolio, then this could be the fund for you. Now we're on to portfolio number 2. And we're going to take it one step further and move up to a 2-fund portfolio. We actually covered this portfolio in last week's video, as it's a portfolio that I've recently switched to myself. As we mentioned before, in the most basic sense, a global portfolio is generally made up of 2 halves, the developed markets and then the emerging markets. So, as you can probably guess, we're going to make up a portfolio that's made up of 2 funds, an emerging markets fund and then a developed markets fund. The options that we have include the ESG Developed World All Cap Equity Index Fund, its UK counterpart, the Emerging Markets Stock Index Fund, and the ESG Emerging Markets All Cap Equity Index Fund. Now, the Emerging Market Stock Index Fund would probably do the job, but it does have significantly less stocks than the ESG counterpart, so we are going to leave that one out. Plus, that means that we'll be left with an all ESG portfolio, which will be a benefit for some people. On the face of it, the 2 developed world funds look very similar, because, well, they are. The only difference is that the UK version is actually operated in the UK, which means that it has transaction costs of just 0.01%, as opposed to the other fund which has a transaction cost of 0.04%. So we'll take advantage of that and invest in the UK version. This gives us the 2 funds that are going to make up our portfolio. All that's left to do is to decide exactly how much we're going to invest in each of the funds to make up our portfolio. We did cover this in the last video, so if you feel like you know this all already, then feel free to skip ahead using the timestamps below. As our funds are ESG funds, we're not actually going to use the FTSE Global All Cap Index, because that doesn't screen for ESG companies. So instead, we're going to use the FTSE Global All Cap Choice Index, which does. The process involves comparing the allocation to each country within the index fund to that of the index, and then we use that to calculate the amount that we're going to allocate in our portfolio. On the FTSE Global All Cap Choice Index fact sheet, we can see that the US has an allocation of 60.85%. The Developed World All Cap Equity Index Fund has a US allocation of 68.1%. So, by dividing 60.85 by 68.1, we get an allocation of 89%. You can go through all of the different countries to check this allocation, but it should give something close to 89%. Using this, we can figure out that we're going to be investing 11% in the Emerging Markets Fund. Again, you can go and check these calculations, but it should all work out. And that's our portfolio complete. 89% invested in the FTSE Developed World All Cap Equity Index Fund and 11% invested in the FTSE Emerging Markets All Cap Equity Index Fund. This gives us an average ongoing charge of 0.206% and an average transaction cost of 0.014%, which adds up to be a total of 0.22%. The portfolio also holds a total of around 7,250 stocks. So this 2-fund portfolio actually invests in more stocks than the previous fund, yet it has a lower ongoing charge by 0.1%. It also has a benefit of investing in companies of all sizes. Plus, it's ESG friendly, which means that socially responsible investors will be able to select it. Of course, the fund will be a little more difficult to manage, as you're going to have to periodically rebalance your portfolio to make sure that the allocations are still in line with the underlying index. But if that's something that you're happy to do for the lower ongoing charge, then it could be worth it. For the next portfolio, we're going to take it one step further, yet again. This time, we're going to build a 3-fund portfolio to try and get the cost even lower, whilst increasing the intensity on the management side of things. Again, this portfolio is very much built upon the fact that you're going to need 2 halves, an emerging markets and a developed markets part. However, this time, the key is to divide the developed markets into 2 parts, using a developed world excluding UK fund, and then by using a singular UK fund. So with that in mind, the 3 funds that will be used to make up this portfolio are the FTSE Developed World excluding UK Equity Index Fund, the ESG Emerging Markets All Cap Equity Index Fund, and then the FTSE UK All Share Index Unit Trust. Again, there was the option to invest in the non-ESG Emerging Markets Fund. That does have a slightly lower ongoing cost. However, we chose not to use the Emerging Markets Stock Index Fund because it tracks an MSCI index, not a FTSE Russell index. This causes some complications because, for example, MSCI classes Korea as an emerging market, whilst FTSE classes Korea as a developed market. So we just chose not to use this fund just to avoid any overlap and confusion. It's also worth mentioning that the developed world excluding UK fund does not invest in small sized companies, only those that are large and medium sized. However, the emerging markets fund and the UK fund does still invest in companies that are small sized, so we will continue to use the FTSE Global All Cap Index as a reference. To stay consistent with the last fund, we'll allocate 11% to the emerging markets so that we still have 89% left to play with. By looking up the UK allocation on the FTSE Global All Cap Index fact sheet, we can see that it has an allocation of 4%. So we will allocate 4% to our UK fund, leaving 85% to be invested in the developed world excluding UK index fund. So that completes the portfolio. We have 85% invested in the FTSE Developed World excluding UK Equity Index Fund, 4% invested in the FTSE UK All Share Index Unit Trust, and 11% invested in the ESG Emerging Markets All Cap Equity Index Fund. This has an average ongoing charge of 0.149% and an average transaction cost of 0.024%, giving an average total fee of 0.173%. The portfolio holds a total of around 5,700 stocks. The number of stocks is actually much less than the other two portfolios that we've covered so far. This is because of the developed world excluding UK fund not being all cap. It only invests in large and medium sized companies. However, the fees are again even lower at just 0.173%, which is pretty damn good. This is balanced out by the fact that the portfolio is that little bit more harder to manage, but again, it could be worth it for the cost savings that you get. Finally, we're on to portfolio number 4, and it's a big boy. A 6-fund portfolio that actually has the lowest fees out of them all. This time, we're going to break the world down into 6 different funds, so bear with me because it is going to get a bit complex. The emerging market side of things is again pretty simple. We're going to go for the ESG Emerging Markets Equity Index Fund. However, the developed market side of things is actually broken down into 5 different funds. We have the US Equity Index Fund to cover the US allocation, then the FTSE Developed Europe excluding UK Equity Index Fund, coupled with the FTSE UK All Share Index Unit Trust to make up the European allocation. Then we have the Pacific excluding Japan Stock Index Fund, coupled with the Japan Stock Index Fund to make up the Pacific allocation. So this combination of funds can be put together to make up a global portfolio. Instead of going through all of the calculations again, because you've seen how it works, I'm just going to show you the result instead to save you some time. The US fund has 61% allocated to it, the European fund has 12%, the UK fund has 4%, the Pacific fund has 5%, the Japan fund has 7%, and the emerging markets has 11%. Now, I just want to make it clear that this combination of funds doesn't actually include an allocation to both Korea and Canada, which make up around 4.4% of the index. There are also maybe some other smaller countries that I have missed. Of course, Canada is not included in the US Equity Index Fund, and Korea is not actually included in the Pacific Fund. So instead, the allocation that would have gone to those countries is instead shared between those two funds. If you really want to include Canada, then you could consider dropping the US Equity Index Fund and replacing it with the North American ETF, which is basically the S&P 500 plus some Canadian stocks. The reason we didn't choose this ETF though is because it only invests in around 660 stocks, compared to 3,800 in the US Equity Index Fund. So we did just want to make it clear that this portfolio doesn't have perfect global coverage, but it definitely does the job. This portfolio has an average ongoing cost of 0.125% with an average transaction cost of 0.025%, adding up to a total average cost of 0.15%. The total number of holdings in the portfolio is 8,300. So this portfolio has the most number of stocks by far, and it also has the cheapest total fees by quite a margin. But of course, you do need to consider that this portfolio is going to be quite difficult to manage, and rebalancing it when it comes round to it is going to be quite a handful. So, as a recap, we've made 4 different portfolios that are all very different. Portfolio number 1 is the most simple, yet most expensive, with every subsequent portfolio increasing in complexity but decreasing in cost. So, the moment of truth. Which of these is the best global portfolio that we can build on Vanguard's platform? Simplicity, diversification, cost, sex appeal. Alright, maybe that last one's irrelevant. Which fund tops them all? Well, I really do hate to be like this, but saying that something is the best is pretty subjective, especially when you're talking about portfolios. We think that it all comes down to what you're personally looking for, depending on your own investing style. If you want a hands-off portfolio where you could put in minimum effort with solid results, then portfolio number 1 could work well for you. If you want to be an ESG investor and don't mind putting in a little more effort, then maybe Portfolio 2 is right for you. If you want to take it that one step further to lower your costs without things getting too crazy, then Portfolio 3 could be a good option. Then finally, if the idea of periodically rebalancing a complex portfolio really doesn't scare you and in fact excites you a little, then maybe you can get the lowest fees by going for Portfolio number 4. Now, if you did really have to push me for an answer, then I'd probably say that objectively, Portfolio number 4 is the best global portfolio. It reaches all of the targets that we set at the beginning of the video, and it does it for the lowest total cost. It's over half as cheap as Portfolio number 1. Costs are one of the most significant factors that will determine what returns you actually end up with. And to show how much it matters, we did some calculations using a compound interest calculator. We assumed that an investor starting with £0 would earn 7% per year, minus fees, for 30 years whilst depositing £200 a month. Portfolio number 1, with the highest fees, ends up with £229,100, whilst Portfolio number 4 ends up with £236,900, which is almost £8,000 more. But again, we do want to reiterate that Portfolio number 4 may not be for everybody. Rebalancing is going to be difficult, especially when you're juggling around 6 different funds, and it can be easy to make mistakes. As you already know, I recently moved over to Portfolio number 2. This is because it matches my investing style and it also reflects my values. If you think you like the look of one of these portfolios, then we would recommend that you actually do your own research before diving in and investing in them. You do need to remember that we just covered these portfolios for fun, and you should by no means take it as financial advice. Just because we made a video on them does not mean that it's going to be the perfect portfolio for you. It's going to take time to figure out what you want from your portfolio, and more importantly, it's probably going to change over time. But when you have decided what you want, hopefully you can refer to these global portfolios as a sort of baseline to be working from. As a matter of fact, we'd love to hear about the portfolios that you invest in yourself, and whether or not you agree with our choice for the number 1 global portfolio. On that note, we'll leave it there. Thanks for watching everybody. We'll see you next time.